Good morning and hello, everybody. Welcome to the NetSuite RevRec Series Part 3. This is Wall Street's take on ASC 606. We have been running a broad series on all the changes going on with RevRec. The first one, we had NetSuite's own controller, Mike Foreman. We had Prasad Kadambi from KPMG on as well. And now we have a very interesting third edition of the show with my friend and good buddy, Kash Rangan, who's the Managing Director at Merrill Lynch. Kash, thanks for joining us today. We'll bring him on in a second. So let me give you folks a little bit of an idea on the agenda. And we're going to talk a little bit about what's happening in the world of technology, some of the big trends that are influencing the market. Kash is going to give us his views. We've got a number of questions on how Wall Street and investors are thinking about some of the changes to the accounting rules. We are going to also take some questions from the audience, so you just have to type in your questions in the magic little WebEx box, and then it'll pop into our screen. And if they're really good questions, we'll answer them on air. And if there are any other questions, we'll make sure we follow up with you guys as well. And with that, I'll kick it off a little bit here. I'll give you a little bit of an overview. So if we go to the next slide, there's Kash Rangan. There's me next to him. Kash is the guy with the beautiful hair. I'm the bald guy, just in case anybody was confused. Let me tell you a little bit about NetSuite. We are obviously one of the first cloud companies. We provide financial, accounting, ERP, commerce software. We were recently acquired by Oracle in November of last year for just under $9.4 billion. We are now a standalone independent global business unit inside of Oracle. I run marketing and strategy for the team. We are doing this webinar really because so many of our customers and prospects are looking at the changes in accounting and what that means to their business. This is probably one of the bigger deals that have come down the road in a while. And so as one of the leading providers of financials, we think it's important to give you some education and color around some of the changes and different perspectives in terms of how it can impact your business. So talk a little bit about what we do at NetSuite. Obviously, this is impacting not just software and service companies, but really anybody who's going public, going to be public, so there's broad applicability in terms of what happens with the accounting changes. I'm going to give you a little bit of color about our guest here. Kash Rangan, as you can read, is a Managing Director in U.S. Equity Research at Merrill Lynch. I have known Kash, I think now for 16, 17 years. You can read his bio here. Kash is one of the rock stars on Wall Street. He's an II top-ranked analyst. I mean, he has been covering the space for a long time, but is also one of the brightest guys about what's happening, not just today, but in the future. I encourage you to read his work, and if you're a private company or a public company in the software space, you obviously know who Kash is and the great credibility and knowledge he has in this realm. So Kash, with that, thank you, sir, for joining us. We appreciate having you here on Spring Break Week.
Thank you very much, Jason, for that very generous introduction. It's been a great partnership with you over the past 17, 18 years. We've grown up in this business together. We've learned a lot together, and it's been a tremendous journey with you with this discovery process. And I think I owe it to the audience to let them know that you gave me a big break at Merrill Lynch about 12, 13 years back, and ever so grateful. And I'm delighted again that we could do this together. Look forward to the next several minutes here.
Yeah, no, thank you. Full disclosure to everyone in the audience, Kash and I worked together for a couple years, 15, 16 years ago. So I can attest to his knowledge and wisdom, and he's gone on to do amazing things. So we are going to, before we kick off on pure ASC 606, I wanted to get a little bit of color from Kash about what's happening in the technology world and the software space. And so, Kash, I'd love to just have you opine on what you see some of the big trends impacting the market and impacting the companies in our world.
Absolutely. A couple of things, Jason. Happy to do this. Number one, a gross profit inflection cycle with many software companies that are investing in the cloud. A few years back, I want to say several years back, starting with Adobe 2011, the transition to the cloud really happened with large cap tech companies. We always have known what the power of a NetSuite or pure cloud SaaS companies has been, but with respect to large companies that are not born in the cloud, making these big investments in the cloud, tanking their gross margin profile to invest in this business with the prospect of a payoff in the future has been a very important theme in software. And what we're starting to see now is a range of companies, whether it's a large company like an Oracle or an even larger company like a Microsoft or others, that are done investing in that cycle and are starting to reap the benefits of gross margin inflection points. So there's a saying in software, as the gross margins go low for a software company, so does the P multiple. And consequently, as the gross margins start to go up, the P multiple of a software company goes higher. So what we saw the last several years was a compression of multiples as investors grappled with the uncertain outcome of these cloud investment cycles. After all, you're taking a 90% gross margin business and investing in a cloud business whose gross margin profile starts off being negative in the beginning and positive very, very late on in the cycle. So a lot of those uncertainties hurt the sector valuations in a pretty tremendous way. But now what we're starting to see is as the first successful test study with Adobe came through with flying colors, there's incredible investor appetite to participate in the gross margin resurgence of mature companies and immature companies alike, because ultimately in software, it is all about the gross margins. As you know, we've learned this together over a number of years, that once you get the gross margin leverage, then the operating leverage follows through. And so we're right now at this point where there's tremendous interest to own software companies on part of investors. After all, there are only two sectors that the U.S. economy has produced in terms of global superpowers that were net exporters. One is internet, the other is software. Collectively, the market capitalization of these two sectors is about $2.5 trillion, eminently investable, and is the bright shining light of our economy in the future. So the long story short, but the gross profit resurgence across the sector as you've started to get leverage from these cloud investments is starting to play out very nicely, consequently leading to record high valuations across the sector. The second point I would make is there is a tremendous amount of interest in the cloud sector, and ultimately what is the longer-term profit potential for some of these cloud business models, and understanding the cost of customer acquisition at a very granular level, the payback period on a unit level, the unit economics of the business, and how does it play out over the long term. And number three, finally, last but not the least, a more topical item has been ASC 606. This is a topic that has been fraught with a lot of potentially confusing takes on accounting, and this comes up quite a bit. I was actually on the road meeting with investors last week in New York, in Philadelphia, over a 4 to 5 day period, and there was not a single meeting that this did not come up.
Yeah, no, I think it's a timely issue, and maybe we'll head to the first question to kind of kick this off, which is for the audience, give a quick one-liner on what the changes are with 606, and frankly, the basic premise here is accounting as you match revenue and expenses, and I think the challenge everyone has from the company standpoint and from the shareholder perspective is, does this change make it easier or harder to understand the underlying economics of a business? So I'd be curious to get your take on that.
So my take, Jason, is that I started covering software in 1997, and that was the time that we had this pivotal accounting standard called SOP 97-2. For those that have been in the business that long will recollect that SOP 97-2 really created a more conservative way of recognizing revenue, that if you have a contingency in your contract that you've not delivered yet, you have to defer the revenue recognition. So I think the industry as a whole over the last 20 years has done a really good job moving to a more and more conservative revenue recognition model, that even if you have a little bit of a contingency, you take the safer route and defer everything, and has therefore created this ratable model. And my first glance, and I still maintain that ASC 606 does not do a better job of matching revenue with the actual delivery of the value of the product. Although I have to say from an expense standpoint, it does a much better job than the prior standard with respect to amortizing the sales commission expense in particular over the expected life of the customer. But even there, Jason, as you might surmise, the assumption what is the life of a customer is a hugely variable one. Some companies might think it's 10 years, some might think it's 20, 30 years. You might sample it based on this quarter or this year or the past several years. It's a highly subjective exercise. So I think the net is that it creates a lot more confusion, a lot more uncertainty, and a lot more confusion potentially.
That doesn't sound good.
It doesn't. It's not fun.
How did we end up in this spot?
But I think somebody needs to go back to history and find out what the merits of 97.2 were and what a great job it did. I think the generational gap, I don't know who at the FASB or SEC is doing these things, and if they have a properly this much of experience, or they're at least 50, 60 years old, and have they gone back over the past several cycles to understand the merit of the old argument. But you know what? That is not our job right now. It is what it is. It's going through, and we're going to do the best job we can, you and I, to make sense of this and guide our clients respectively.
Great. Well, we're gonna hopefully answer a few more questions in this hour for folks to give them some color and what to look for. So, with that, next question. This is kind of an interesting one, and I think this will be right up your alley in terms of your expertise. So, with public company adoption in 2018 or an option for 2017, what does this mean for a private company that's thinking about an IPO in the next year or so?
I think, and we see this in our jobs in vetting private companies as they embark upon the IPO process. What I would say is that it's much better from an investor standpoint or an analyst standpoint to have the private company that is thinking about the option of entering the public markets to work on ASC 606 aggressively, although it may not be quite the time frame that you're required to follow ASC 606 with respect to your accounting practices. I would highly, highly recommend that whoever is thinking about an IPO at some point in the future really take a very proactive attitude towards ASC 606, and here's why. So let's say you go public now and you're doing your accounting based on the existing standards. You are 3-4 quarters into the process, and then you got to file for ASC 606. It's a very time-consuming, expensive, potentially confusing exercise as you are attempting to change your financials midstream, not suggesting that the change and the scope of change is that massive, but it is enough to be potentially confusing and distracting your public company management team that is required to file your 10Qs and 10Ks in an orderly manner. And here comes along ASC 606. You are required to produce audited financials going backwards over the past at least 4 quarters. It's a very costly, disruptive change. So at a time when the investors in an IPO are looking for this, given the lack of runtime and history with Wall Street, they're looking for a little bit more certainty, a little bit more predictability. And you throw in, after 3-4 quarters of putting up results, another big change that could undermine investor confidence. So, and I think the question that was also asked on the slide, what are the common traits investors are looking for in an IPO? Track record of consistent, predictable execution, which I think if you adopt ASC 606 a little bit earlier than what you require to, it actually helps your case. And the other thing that is quite obvious is scale and a path towards profitability. And with scale, that can be interpreted as $100 million, $200 million, $300 million in revenue. That depends upon the company's definition of their end market and how big the TAM is and how therefore their scale would appear in light of the overall TAM. But this is how I think about, if you ask me the question on ASC 606 as it relates to a pre-IPO company.
Yeah, and I think that one of the follow-ups, and we had a really interesting question from Greg in San Francisco. He wrote in, and he said, I understand that most companies with mixed revenue models, term, perpetual, maybe subscription, will adopt the full retrospective method. However, for companies that are already pure SaaS, where the changes are somewhat immaterial, are they doing full or modified? What have you seen out there in the field, or do you have any insight on what folks are most often trying to undertake?
That's a great question. I think it's a mutual friend of ours, judging by the location and the first name. With respect to, we go back way back, 16, 17 years, maybe 20 years. Anyway, nice to hear from you, Greg, if that's the right characterization, and I think you are. But with respect to pure SaaS companies, it is less disruptive. Obviously, that point is well taken. But even among pure SaaS companies, you've got a range of contingencies that are delivered with these contracts that gives you a little bit of a judgment as to whether this product is actually something that I'm shipping right now. It may not be ready for prime time. I may be holding back the rev rec and the invoicing of the customer just to give the customer a little bit of a grace time, or give myself a bit of grace time before the customer is comfortable with the quality of the product. Those things go away. And it's not clear that there is a standard for interpreting these kinds of things across multiple companies. So some companies may be completely unimpacted by the change, but some companies could be impacted by the change. There's also the concept of a ramp deal, where you bill the customer for $100 in year one, $200 in year two, $300 in year three. But now those ramp deals will be more uniformly recognized. So we don't know what percentage of new business or existing new business particularly is ramp deals versus not. And those practices tend to vary wildly across SaaS companies, although they have the same business model. So yeah, it does cause some changes to the way you would be recognizing your reported revenue. As you reported revenue in the event you've been doing ramp deals, and now you can't recognize all of a sudden uniformly a third. Your reported revenue accelerates by a few percentage points. Your reported billings or deferred revenue growth rate will decelerate by a couple of percentage points. So these are all very important things to get behind, even though you may be a pure SaaS company.
Great. Well, we're going to take our first poll here following that set of questions here and ask the audience, what type of company are you? Public, private, targeting an IPO within the next couple of years. So we'll give folks here on the line a chance to interact with us and get a sense for the audience. And it'll take a few seconds for us to compile the results. I would guess most folks are private. And with the IPO window perhaps being a little more open, we might see a few more public companies than we did probably a year ago. And the folks handling the poll are not the same folks who handled the Best Picture nomination at the Oscars, so they've got that going for us to be a positive. No La La Land problems here at the Oracle NetSuite webinar. We have the results. And it looks like, interesting, it's about 1/3 are public, 2/3 are private, and like 5-10% of y'all are going to try and go public in the next year or two. So, well, let's go on to the next question here, because I think this gets into some of the practical advice. So for all of you folks who are public or are thinking about going public, you get to deal with the wonderful world of sell-side and buy-side analysts who are going to rip apart your business model and ask you a ton of questions and put a lot of inquiring eyes onto your business. So, Kash, what are some of the things that you and your brethren are doing to get ready for this change?
First of all, Jason, don't take off on the sell side, because you're the first guy, analyst on Wall Street, that published the first report on cloud computing in 2003, 2004. So, you take a little bit of responsibility for having created this monstrous awareness on Wall Street about the cloud.
I disavow any involvement in the calculated billings numbers. It's not my fault anymore.
Anyway, so I think our jobs are going to get a lot more complicated as a result of this big change. There's going to be new information that is going to be generated, which analysts are always in quest of more information, but when companies provide more information, there's always the quest for even more information. At some point, you've got to cut it off. But what ASC 606 requires you to do, and maybe a little bit frustrating for companies, is to have more disclosure, a lot more disclosure. So with respect to financial models, we're going to have to prep for disclosure of off-balance sheet backlog. We've always been in the position to receive information on deferred revenue, so that's more of a balance sheet calculation, therefore calculated billings, to your point. However, when calculated billings don't really matter due to the timing of certain invoices or what may be structurally agreed upon in terms of a contract between a vendor and a customer not being fully reflected in what is actually being billed, we eliminate a lot of the disparity by having companies required to report a backlog and also give a timeline as to when that backlog is going to be recognized in terms of revenue. So that is going to be an additional source of input into our financial models, and hopefully the plague of billings that has been a frustrating one for company managements, maybe that goes away a little bit, and if the backlog shows you a better picture and the growth in backlog is a more fair representation of the growth in net new business, meaning net new backlog, et cetera. If that portrays the company in a better light, I think this might end up being a fruitful exercise. But again, in the interim, it has the potential to be interpreted in confusing ways and leading to more volatility in the financial markets, because we're used to, for a company that's been public for 10 years or so, we're used to understanding patterns with billings growth rate and deferred revenue, seasonality, et cetera. But we're not used to simply dealing with seasonality of backlog, and we don't have that runtime with these companies having reported off-balance sheet backlog over a very long period of time, and also on a quarterly basis. Even companies that provide it on an annual basis, that's fine, but understanding the movements quarter to quarter can be very complicated. So right off the bat, I don't mean to scare anybody, but I think it's the reality that let's be ready for a period of volatility. In fact, I met with one client last week. Jason, you might appreciate this. This is a fund. Cannot name the fund. It's more of a high frequency trading firm, and they take advantages of temporary market fluctuations and imperfections. They'll trade for 25 basis points of a spread, 50 basis points of a spread. They asked me what is this ASC 606, and explained to them in a nutshell in 5 minutes. Their eyes lit up. When I said there's going to be more volatility and more confusion, they were just salivating. So that tells you how much confusion there could be in play here, interpreting company guidance, incorporating that guidance, and measuring company results against that guidance, when the company itself has not had a chance over the past several years to have a projection, internal projection of their own off-balance sheet backlog, and having a history of meeting these backlog estimates. It is going to be a wild ride.
Yeah. Well, it leads us to the next question, which is, do you think companies will still offer billings guidance?
I don't think that really changes. A company that has run its business on billings, I know most companies have ACV, net new ACV targets, and not an explicit deferred revenue target. The companies that have been in a position of offering billings guidance, and maybe that's one of their KPIs, and they understand that the street and the stock reaction, especially for profit model that has not reached maturity, where you have a big chunk of your, let's say a stock is valued on cash flow and not on earnings, and half of that cash flow, I'm just making up a number, is from deferred revenue. Some managements understand that cash flow, and half of the cash flow being driven by deferred revenue, has big implications for the valuation of the company. They've done a pretty good job guiding to reasonable billings outcome and hitting or exceeding that billings outcome. I don't think it changes for those kinds of companies, but companies that have had traditionally a bit of variance and volatility in their billings due to seasonal reasons or structural reasons, I think it gives them a chance to not offer billings guidance anymore, but instead say we're going to report a lot more information, such as off-balance sheet backlog, and you're going to be in a better position, not a worse position.
Yeah. Well, what's interesting, the billings number has always been a proxy, right? You and I, and every person in finance knows the billings number doesn't perfectly reflect the bookings activity in the business, but it's been the closest thing the investor community has had to a proxy for that figure. And I'm curious, and this is where we'll go to the next question then. So if billings guidance doesn't change, and we're going to look more at, if you will, basically a bookings figure and these waterfall schedules in terms of what's going to get recognized, can you give us some insight into what's changed in terms of how backlog needs to be reported, and what are the things then analysts like yourself are going to look for in that backlog figure to try and deduce, if you will, how well a company is doing in a particular period?
Yeah, Jason, that's a very good question. So if we get information on backlog quarter by quarter, and we can calculate the change in the backlog from previous quarter to the next quarter, and look at the second derivative, net new backlog, that is the closest proxy for net new ACV. Because ultimately what investors would like to understand, you never really escape from understanding the second derivative of growth for your business. So back when you and I were covering the predominantly license model driven software industry, it was a licensed revenue that we're all focused on. The Street was focused on licensed revenue because that every dollar of licensed revenue paved the path for $2 or $3 of maintenance. So it was a big thing to focus on as a leading indicator of business. Now, deferred revenues and billings have taken the role of licensed revenue. And with the deferred revenue being a little bit suspect, especially for companies that have a big disparity between what gets billed versus what gets booked. And I'm not suggesting that is the case with every company. Most companies that are young generally tend to have big disparities and fluctuations in the trend of backlog growth versus bookings growth, or billings growth rather. But in this case, the requirements are onerous. We are talking to people in the auditing community that think of this as a separate business opportunity. That we're a SaaS company has to provide audited backlog and revenue recognition schedule. These things can be very time consuming, and they're think of engaging in a separate set of auditors to conduct these checks. So this is uncharted frontiers, and I think this is going to require more analysis, more auditing investment, and more time and resource commitment on part of companies. And also, this is something that you got to be willing to sign off with the SEC. This has got to be perfect and accurate, and you've never done this before. And you've only given a loose backlog number that has been rounded in some instances to the hundreds of millions of dollars, to the closest billion, and you cannot do that anymore. So this is going to require a lot more work, and the counsel that you and I ought to provide to listeners on the call is just be prepared to get a handle on this ahead of time before the requirements become too onerous and you've not had enough runtime to audit your backlog, off-balance sheet backlog particularly.
Geez, what could possibly go wrong in this scenario? Yeah, this is a level of, I got to say, as a former Wall Street, this is a level of transparency into businesses that, I think investors would welcome, but it also creates this reporting requirement that is like down to every detail of almost every contract that's signed, which is not something most companies are used to having to disclose and account for. At least in terms of, the granular data that I think that the new requirement, mandates. Well, with that on the backlog, then this goes to the next fun one, which is how does this affect the structure of sales commissions? And be curious to see how this helps or hinders your ability to kind of dive into those numbers, Kash, as you look at sort of the commission expenses.
Massively confusing, Jason. I think this is not going to be easy at all, because again, to our earlier point, one of the things that Wall Street is trying to get a good handle on is the unit economics of a business, and the unit economics of the business is partly determined by the life of the customer, and in this case, if the standard requires you to amortize the sales commission over the life of the customer, it's a highly subjective thing. So you better have documented systems that many companies, private companies, are not in a position to have done, but unfortunately you're going to have to do this to understand at a customer level. Going back, let's say you've got 1,000 customers, you have to have documented history of how long that customer life has been to be able to do a cohort analysis. What were the new customers that you acquired 5 years back? How much did that cohort stay on 4 years back, 3 years back, 2 years back, 1 year? How much is the volume of business that is being done today? And therefore, you have a reasonable basis to be able to explain to the SEC when it comes to filing for your financials why you chose the customer life of 10 and not 8. It needs to be statistically relevant, and I know this for a fact that many private companies have not really gone back and measured the life of a customer. And so you're going to have to start to do this because it's one thing potentially confusing for us as Wall Street analysts to be able to understand the profitability of the business, but another thing for customers or companies that are looking to access the public markets as to how you report on this, and to be able to report on changes with a certain customer, because a customer might have a longer history in life and therefore comfort factor for you, that you choose to recognize your sales commissions on a longer time horizon than an unproven brand new customer whose customer life association with you is just not simply known, right? So there are all these big question marks, and I think our life is going to be a little bit complicated here as well. Because we are in an unfortunately tough position of being able to compare companies across the sector when we know for a fact that the way in which they amortize their selling commissions are all very different. So the profitability of the business is going to be less important than the cash flow of the business. The cash flow of the business does not lie, so we're going to resort to the one thing that we all can live and die by, which is cash flow.
Okay, that makes sense. Well, now that we've scared everybody to death, we'll ask the question, has this increased uncertainty among investors? Yes, no, I don't know. I'd be curious if we asked this question before you and I tried to scare everybody with the reality of what's happening.
Jason, yeah.
Go ahead.
No, go ahead. Go ahead.
I was going to say, I have a feeling our audience knows. Most folks are interested. So they're like, yeah, we've heard this.
It's hard to not come across as scary because it is the reality. But I owe to my former colleague, Mitesh Dhruv, who actually is Senior VP of Finance at Ring Central, to actually bring me to the awareness of this topic. When I heard this, I was stunned, and I dug into it. I got even more stunned because I've not seen anything like this in the 20 short years that I've covered the sector, starting with SOP 97.2. This is scary.
Well, about over half the people think it's going to increase uncertainty for investors, so that makes sense. Let's go to the next question, though, because I think this will be helpful for folks, which is, you've talked a lot about this, Kash, and have published on this for the last couple of years, and I think the thing that every CFO, head of investor relations, VP finance, probably even CEOs are going to ask is, what are some of the ways that we can avoid some of the uncertainty? So what's your best practices advice for the folks on the line?
Thank you so much, Jason. That's a very, very important question. I think you have to be ahead of the game. So to postpone, I think we can all go back to relate to the concept of finals during our college years that some of us are habitually, like me, last-minute folks that cram for the finals. And in this case, that is not something I would recommend. Just do not put off till the very last minute and take protection from the fact that you don't have to implement it till a later point in time. Do it as quickly as you can, because you're not going to find out what you don't know and what surprises you till you actually get into the process. So get on it today, ASAP, right away. That's one thing. Second is let's say you plan to go public 2 years from now. Pretend that you're running a business using the ASC 606 standard and develop a degree of comfort reporting on it internally. It's all dummy reporting, but still gets you in the habit of doing this quarter after quarter after quarter, understanding the planning cycle. What were you planning for, and how did ASC 606 cause you to experience some changes in the way you expected your financials to play out? And consistent communication. Be able to talk the new lingo very consistently, over-communicate, and do seminars for Wall Street analysts. halfway through your quarter, do a refresher. This is how our financials are going to change, and we want to be able to give you a 45-minute webinar, something like this, to your constituents, whether it's sell-side analysts, buy-side analysts, whatnot. I get into that habit of talking that lingo very consistently. I think ultimately that will allow you to control some of the volatility, but not all of the volatility. And the final fourth thing that I would add is spend a lot of time on it, pretend you're running a business this way, and come up with a longer-term forecast. Companies that are able to offer a bit of assurance on how this is all going to shake out ultimately 4 or 5 years from now when the model stabilizes. What does your financial profile look like? Let's say a hybrid business model company. I'm not going to mention names, but a combination of license model plus subscription model plus cloud model. Understandably, as confusing as it can be, try to give your best shot, your best estimate as to what the composition of your business looks like 3 to 4 years from now. What does under ASC 606 your profit model look like 4 to 5 years from now? You're not going to be perfect, but if you give us your best estimate as to how your business looks like under the new accounting standard 3 to 4 years from now, after having gone through the initial bit of volatility, at least people can visualize the end game and invest with confidence.
Yeah. So I want to break some of those down because there are some real interesting tidbits in there around best practices. So one comment you made about basically operate as if you're public prior to going public. Do you see a lot of, on all the IPOs that you've done over the years, do you see a lot of companies doing that? Is that something that you find is the norm, or is that the exception right now?
Zero.
Okay.
Nobody's doing it.
Okay.
We had a chance. Yeah.
Yeah. So what do most companies do right now?
If you're private, you just what is it, the expression, the ostrich sticking its neck into the sand or something? Is that the right expression? That is the way most seem to view this. I'll get to it later, or I will get out now before the standard takes force. That is not quite. Because you're better off doing this. You're better off going to ASC 606 and then doing your IPO, so we don't have to reckon with complete set of restates, right? A lot more volatility. You're better off putting your best foot forward and having consistency in your messaging. That's the way I would advocate, but I know there's some practical limitations to how quickly you can do this. But maybe the best thing is to wait a little bit longer, do this thoughtfully, implement the best practices, make all the modifications, and undertake all the investments that you have to do from a software and systems integration consulting perspective, and then be ready to fly, because you get to have one chance to make a good impression.
Yeah. Most companies tend to hire their head of investor relations, later in the game in terms of their proximity to an IPO, or maybe when they're, filing the S1. Do you think this will effectively make the best practice change from that standpoint and start to hire the investor relations folks earlier so they can work on the external presentation of these metrics?
Yes, pity the poor IR folks, right? They get stuck with this. Wow, what a great way to start your job. No, I think there is something that I've not really given thought to, but I was listening to your question and thinking about it, and I thought to myself that would be a great thing that companies can do. That, given that you're a CFO or VP finance of a company and you're busy as it is, scaling your business and providing the right level of internal controls and funding to operationalize your business, the last thing you want to do is to have your time consumed by explaining how ASC 606 would, because it's all external, right? This doesn't really change the way the company does its business, but it's all about empowering the investor or providing more information. So yes, I would agree with you. That's actually a brilliant suggestion from your part. I like that.
Interesting. Yeah.
I'm going to use it.
Well, and so go for it. It's interesting because one of the other things that you mentioned, I think, and this is probably one of the gripes with Wall Street is, a lot of folks look at Wall Street and say, oh gosh, all they do is think about the short term. They live life in, sort of 90-day quarterly cycles, and, they're not focused on the big picture. So one of your last pieces of advice was, hey, think about long-term guidance, think about 3-year roadmaps, think about how the business will look at a target operating model down the road. We see that sometimes, or you probably see that sometimes with IPOs, but is this something that you think will then become more widespread, that this will give companies that opportunity to present, if you will, a longer-term time horizon for how the investment should look?
Yeah, and I think you've always had this obligatory in the IPO slide deck, what the long-term operating model ought to look like. But I think what I'm advocating for is to put some specificity into that long-term, because long-term could be, I don't know, by the time I have grandsons, or long-term could be by the time my 10-year-old becomes a teenager. I don't know. I think you have to be a lot more specific. And I think if you look at the public marketplace, Jason, some of the companies that have been able to successfully gain investor credibility and achieve market caps of 60, 70 billion and go through a process of 5x, 4x are the companies that have been able to provide specificity to the time duration of the longer-term targets. So for some reason, I think Wall Street likes companies that are confident and can provide their clairvoyance and fully understand that these targets are not, they have some fallibility to these targets and a bit of variance to these targets, but the companies that are able to provide some forward-looking view, not to say that long-term my margins are going to be 20%, but to be able to say year 2021, I'm targeting 18 to 20% operating margin. I'm targeting between $2.5 to $2.7 billion in revenue. Although you will end up being wrong most likely, I think people value the companies that are able to provide, particularly in the context of ASC 606, and the longer you pretend to have been a public company while being a private company doing ASC 606, the more confident you can come across as projecting your longer-term financial outlook and being very specific about it. 2020, 2021, this is the revenue range, this is the operating margin range that I'm going to target, and that gets you in hopefully in the process of imposing some discipline upon yourself as well, so as to not dilute your model with overspending, higher cost of customer acquisition, not accepting low quality business with low ACV, etc. It puts you in a very good position to. You made the commitment, now you live by that commitment. It's actually good for you as well, although it might be a little bit restraining and a little bit limiting. It is actually going to be very good for you. And if you do it and the other guy does not do it, you get significant and valuation multiples for companies that provide this guidance. We have companies in our coverage that are relatively in mature sectors that are trading at 8 to 9 times revenue multiple, because they just provided the longer-term uncertainty. Certainty. When I say long-term, it's actually calendar 20, calendar 21 type time frame.
For larger companies that have more predictable business models, that might be somewhat easier. What about some of the private companies that, frankly, maybe don't have that operating history, or are in a I don't want to say volatile market, but in, say, a rapidly growing or emerging category? How should they best navigate those waters?
That's a great question. I think in that case, what you can say is give a growth rate percentage and say, if our growth rate is X, this is the kind of margin profile that we expect to have. So that way, you're not pegging yourself into a tight corner by saying we're going to achieve this much in revenue. So granted that a $1 billion revenue company probably has much better visibility into when it'll attain $3 billion in revenue and whatnot. We are a much younger company. I admit that your point is really well taken, that you've got to think more constructively in terms of growth rate and margins under those growth rate assumptions rather than a specific point number.
Yeah. So it's providing that framework. If you're going to grow 40%, we'll break even. If we grow 30%, we'll make 10 points of margin. If we grow 20, we'll be 20. Kind of those benchmarks along the way. Is that kind of the way you would advise folks to frame it up?
Exactly, and I think that 40 rule or whatever it is was generated by somebody in the VC community. I've not really thought about it much, but you got to do what's right for your business. Ultimately, if you're a young company, you know what your total available market is, and you know realistically what percentage of the total available market you can garner, and you know what your sales model is. You know how productive your salespeople are. You know how many people you have right now. You know what the cost of customer acquisition is. You know, therefore, given your burn rate and how much money you have in the bank right now, how much the resources you have to get from point A to point C, and therefore you have a very good view as to how big of a business you can build before you need to tap the financial markets, whatnot. So you don't need to be pegged in very considerably. You have a you have a view and you have a plan based on your TAM and economics of the customer acquisition. Does that make sense, Justin? Jason? Sorry. Yeah.
Yeah, no, that's a good way to frame it. I think everybody's got a different situation, but sort of following these frameworks, I think, is a useful tool. So, all right, let's move on to the next one. We've got our last question. Question 3 is, we'll ask the audience here, are you concerned that your current systems will hinder 606 adoption? Yes, no, maybe not. Who knows? And, folks, we're coming close to the top of the hour here, so if there are questions out in the audience, please type them into the little WebEx box, and we will be sure to ask any questions that you folks have. Okay. All right. Well, the results that popped up here, it does look like probably 2/3 or so are concerned or not sure. So only about a quarter of you are confident right now, which is good. I think this is going to be an interesting sort of 24 months for all the parties here in this ecosystem to get their arms around. Kash, we appreciate your insight here. I guess we're going to see if we have a few questions from the audience. It looks like, well, I got one here, which is a sort of final question. We'll make this. In a perfect world, Kash, does this fundamentally change the value of a software business or a tech business in the long run, or is this a 24-month transition that we just ride out? How do you think this impacts the long-run game?
It's an easy one. It's the latter. It doesn't change the long-run financial picture or the fundamental or the value of a company, which we all know is the present value of its cash flows, discounted cash flows. That doesn't change. This is strictly a 2-year adjustment period. Maybe it happens a little bit quicker. Maybe, hopefully, it does compress the time window of uncertainty, keep it as short as 12 months. Because once you get into the habit of providing 4 quarters, with comparable results from a year earlier, at least the worst of the volatility is behind us.
Great. No, I think you're right. I think that's right. It's just how you do it and what are the steps you have to take to make sure if you're private, you can get public, and if you're public, you can be as transparent and thoughtful about these changes with your external constituents. Well, with that, we've ran out of time. I want to wrap this up. First, let me give you a couple housekeeping items. Part 4 of this RevRec series is going to come up. This is going to be the live demo of our own advanced revenue management capabilities. We have unified billing, obviously integrated natively into our general ledger with support for all of the RevRec standards. So April 19th, please be sure to dial in. That'll give folks a little bit more understanding of how we actually tackle this problem from a product standpoint. The second thing is, if you haven't signed up yet, whether you're a customer or prospect, please join us in Las Vegas here in about 3 weeks at SuiteWorld. SuiteWorld's in Las Vegas. We are going to have a ton of sessions on RevRec, folks from NetSuite, our customers, KPMG, all sorts of folks, Deloitte, who are going to be there talking about how this standard is going to play out and how they can help you. And last but not least, you can go to netsuite.com/software, and we'll get you some content if you're looking for it on how we are addressing this challenge. But with that, Kash, I want to thank you for your time. I think it was fantastic. I know the audience got a lot of benefit from hearing your words of wisdom, and we look forward to doing some more stuff with you on the road and helping educate and get folks up to speed on this very important topic.
Absolutely, Jason. It was fun to be with you, and I think Oracle and NetSuite are really fortunate to have someone of your caliber leading the charge with your function, having been a very thoughtful, smart analyst who I've learned quite a bit from. So I'm really happy that you're able to put this together for your audience, and I hope that this was beneficial.
You're too kind. You're too kind. Thank you so much, though, Kash. You're the best. We appreciate it. And everybody on the line, thank you for joining us. If you have questions, please email us or contact your NetSuite account rep, and we'll make sure if there's any follow-ons, we get the right answers to you as soon as we can. So with that, everybody enjoy their spring break if they're on spring break, and go back to your happy Monday, and we will talk to you soon. Thank you.